Hi, welcome to Market Minute. This is where we analyze the markets looking for opportunities, but most importantly, protecting our portfolios when we think we need to. So we're going to walk through the bull and bear case. They're very simple. We'll do a high level view of it, and you can decide which one that you believe has more substance to it. But first, we want to talk about what happened in the markets last week. So it was a holiday week, given that most of the financial guys take off early with the Labor Day weekend on Monday, and stocks tend to creep higher when that occurs. So there's some fluff in the markets. The markets will have to take that back out as we go through September. But what happened last week was kind of exciting. We had a relief rally in the 10-year Treasury. The yield of the 10-year Treasury went from 4.33% down to 4.09%. You can see that decline there. So it went back below the 4.25, where we kind of have a line in the sand of where to be cautious. However, it went right back up. So come Monday, the yields went right back up. It kind of feels ridiculous to be so concerned about interest rates and their movements on such little moves, but it's important because the high valuations in the stock market, along with very slow earnings growth, there's not much leeway in the valuations. So if interest rates go up, it has a big impact on the valuations of the stock market. Conversely, if they go down, it's a big benefit. If we had strong growth, we wouldn't be even talking about the yield on the 10-year Treasury at 4.25% at this point. So looking at the bull case is inflation will moderate. We're seeing that. So inflation has been coming down. The core rate's kind of sticky, but the overall inflation has been coming down. GDP growth will stay positive. So lower inflation, GDP staying positive through next year. The 10-year Treasury will drop in yield from 4.25 roughly currently to about 3.5. That gives you 20 times, a 20 multiple for the S&P if we can get down to 3.5. So 20 times the $246 in earnings for the S&P next year gives you a target at 4,900 on the S&P. So upwards of 9% in terms of appreciation for next year. So that's pretty attractive. So the bull case has some merits to it. However, it requires the 10-year Treasury coming down and also GDP growth staying positive. The two generally don't go together. If the bull case is right, the beneficiaries of this is that the S&P equal weight and the Russell 2000, so small cap stocks, have probably a bigger move in them than those top 7 or the technology names that everybody's plowed into at this point. So the top 7 stocks have accounted for roughly 70% of the returns of the S&P 500 this year. So you can see how undervalued the underlying market is. It really hasn't moved much at all, yet those 7 stocks have been very strong. So if the bull case plays out, the market will broaden even more, and those stocks, those smaller names will have probably a very significant rally to them. The bear case is real simple. It takes a while for interest rates to work their way into the economy. Once it does, if you have an inverted yield curve, you always have a recession. So let me walk you through that. You can see the inverted yield curve. This goes back to 1980. Inverted yield curve, recession. Inverted yield curve again, recession. So as we go through time here, every time we have that inversion occur, so it's the 10-year Treasury minus the 2-year Treasury. When the 10-year Treasury is lower than the 2-year Treasury, that's an inverted yield curve, which causes the banking system to dry up, so less loans created. Doesn't give any incentive for the banks to make loans if they have an inverted yield curve. So as you can see here, we've had quite the inverted yield curve recently, and likely we'll have a recession next year. That's our view. We think the bear case has a lot more merit at this point than the bull case does. So that makes the multiple on next year's earnings is too high, given the fact that the earnings will probably be flat to down as much as 20% next year. So the markets will have their typical 20% decline if we go into a recession next year. A couple of things that bother us in the short term is the labor unions are heating up. There's strikes occurring. The United Auto Workers like will go have a strike. The auto sector is a big part of the overall economy, so that will be a headwind for the overall economy. The consumer is really starting to struggle, especially at the low end. The cumulative effect of inflation is having on the consumer is very pronounced. So we see that housing prices have been up roughly 40%. That's very inflationary. Goods prices 20, services at least 25. So wages have not kept pace with inflation. So what's the consumer doing? They're increasing the charges on their credit cards and they're cutting way back on the savings rate. So they're running out of money basically. Next year, the federal government will likely spend a lot less than what they did in the last 2 years. You're going to see a contraction in terms of government spending, so that'll be another drag on the economy. Remember, September, they need to pass a budget. I don't know if these guys could actually do it again, so that's what concerns us in the short term with the government, is that passing a budget by the end of September, I wouldn't bet on it. So there's a lot that could go wrong here. Let's recap a little bit. So the market valuation is full. You need lower interest rates. You need the economy to stay strong, and you need the market to broaden out. There's a lot going on there. Kind of feels like it's not going to play out. Here's the technicals. So we're above the 20-day, but the 20 days now dip below the 50-day. So that's a little concerning when the shorter term moving averages start to break the longer term moving averages. We'll see how this plays out. Remember, September is generally a very tough month for the overall markets, and we're quite a distance away from the 200-day moving average. Lastly, we have an investment idea for you. As you know, at PVG, we manage loss averse portfolios and tactical strategies. We have a portfolio called High Income 10. It's 10 stocks. It kicks off a 7.5% dividend yield. Those stocks are high quality. Don't think they're going to miss dividends. It's a nice way of waiting out a potential bear market or uncertain about a bull market. It's a really nice way to pick up some income. If you are an individual investor, you need any sort of distributable income, this is a really nice portfolio. You can come on my website, Patrick Adams CFA. If you want some more information, just shoot me a message. Take care.